Welcome to the Deep Dive. Today, we're unpacking MSCI's Q3 2024 earnings call. You sent this one in, and I can see why you're curious. On the surface, some numbers look great, but the overall tone from leadership is a little, cautious, wouldn't you say?
Cautious, putting it mildly. I'd say there's a definite undercurrent of concern, despite some undeniably positive results. It's a fascinating snapshot of the complexities businesses are facing right now.
Okay, let's break it down. What were the highlights for MSCI this quarter?
Well, first off, their total revenue growth hit 16%. Adjusted earnings per share are up 12%, and free cash flow growth is a staggering 46%. Those are numbers most companies would celebrate.
Definitely not numbers to sneeze at. What's driving that strong performance?
It seems everyone's hopping on the indexing train, which is great news for MSCI. Their asset-based fees, driven by ETFs and passive products linked to their indexes, are soaring. This makes sense given that indexing is generally seen as low cost and relatively low risk. It's like a broad bet on the market as a whole.
But as they say, there's always a catch. What's the but in this story?
The but is that sales to asset managers, a core client for MSCI, are still soft. It seems even though the market's doing well and these asset managers are seeing their own funds grow, they're still hesitant to increase spending. It's as if they're waiting to see if the good times are truly here to stay before loosening the purse strings.
A bit of a lag effect then. Interesting. MSCI did mention some early signs of improvement though, right?
They did. So there's hope that spending from asset managers will pick up soon. But for now, it's definitely putting a damper on MSCI's overall growth.
And then there's the whole ESG and climate segment, which seems to be hitting a bit of a speed bump as well. What's the story there?
MSCI called demand subdued. Their net new recurring sales in this area were down significantly year over year. This is surprising, given all the focus on sustainability and climate change. You'd think demand for these products would be skyrocketing.
Right. Seems like that's all anyone talks about these days.
And MSCI's leadership seems to agree. They're attributing the slowdown to cyclical factors, not a fundamental lack of interest. They believe this ESG and climate focus is a secular trend, a long-term shift in how investors think. They're essentially saying, don't worry, this is still a huge opportunity. It's just taking a little breather right now.
So they're not panicking, but they're also not ignoring the slowdown either.
Exactly. And to prove they're serious, they brought in a new head of ESG and climate, Richard Madison. He's got an impressive background, having founded and run TrueCost, a major player in climate risk assessment. It's a clear signal they're doubling down on this segment for the long haul.
Bringing in the big guns. Got it. So we've covered the good and the not so good. What about the intriguing insights? Anything that really jumped out at you from this call?
Definitely. A few things, actually. First, MSCI is successfully taking market share from competitors in analytics, even in this tight environment.
That's impressive. So even with budgets constrained, clients are willing to switch to MSCI if they see enough value. Why is that? What makes their analytics offering so compelling?
It seems they're striking a chord with clients by going beyond just measuring risk. They're helping them understand the factors driving that risk, like specific exposures within a portfolio. They're also providing tools to assess portfolio construction and even climate-related risks, all built on their decades of data and analytical expertise.
So it's about giving clients a deeper, more nuanced understanding of their investments and the forces shaping them?
Precisely. And it's working. MSCI's ability to connect the dots between different types of data, from risk models to climate data, is giving investors a more holistic and valuable view.
Okay, fascinating.
Yeah.
What else stood out?
Well, they're making some strategic moves in private assets, another area they see as having massive growth potential. They've launched new private capital fund indices and brought in Luke Flemmer, formerly of Goldman Sachs, to lead this charge.
Hold on, Goldman Sachs. That's a pretty big name to snag. They're not messing around, are they?
Not at all. And it makes sense. Private assets are becoming increasingly important for institutional investors, and MSCI wants to be the go-to source for data and analysis in this rapidly evolving market.
It seems like they're recognizing the shifting tides and paddling hard to stay ahead of the wave.
That's a great way to put it. They're not just riding existing trends. They're actively seeking new avenues for growth, leveraging their existing strengths to do so. For example, they're using their climate risk expertise to develop custom indexes for clients looking to decarbonize their portfolios.
So they're transitioning from just selling data to crafting tailored solutions that address specific client needs. That's a big shift, isn't it?
It is, and it points to a larger trend in finance customization. Investors want products and services tailored to their unique goals and preferences. MSCI is tapping into that by offering bespoke solutions, especially in areas like direct indexing and thematic ETFs.
Okay, so we're seeing a company facing headwinds but also making bold moves to capitalize on emerging trends. It's a mixed bag, but with a lot of potential, right?
Exactly. MSCI is acknowledging the challenges while simultaneously highlighting the silver linings on the horizon. Their performance is a fascinating reflection of the broader trends shaping the investment landscape. It'll be interesting to see how it all plays out. It certainly will. This is a company worth keeping an eye on.
You mentioned MSCI is displacing competitors in the analytics space. That's got to be a good sign for them. But I'm curious, what exactly makes their offerings so compelling? What are they doing that others aren't?
They're definitely leveraging their deep data sets and analytical expertise, something they've built up over decades. They're known for sophisticated risk models used by many institutional investors. But they're not stopping there. They're going beyond traditional metrics to offer tools that help clients understand things like factor exposures, portfolio construction, and even climate-related risks, all in one platform.
Hold on, factor exposures. For those of us who aren't finance wizards, can you unpack that a little?
Of course. Think of factors as the underlying drivers of return in the market. Things like growth, value, momentum, size. These are all factors that can influence how a stock or a portfolio performs. Understanding your exposure to these different factors can help you make better investment decisions.
So it's not just about knowing how much risk you're taking. It's about understanding what's driving that risk and whether those drivers align with your overall investment strategy.
Exactly. And that's where MSCI's breadth of offerings comes into play. They can connect the dots between different types of data and provide a more comprehensive picture of risk and opportunity. It's not just about numbers, it's about insights.
That makes a lot of sense, especially in today's market, which feels increasingly complex and interconnected. Investors need tools that can cut through the noise and help them make sense of it all.
Absolutely. And MSCI seems to be recognizing that need and evolving their offerings to meet it.
Okay, so we've talked about the positives of their analytics business, but are there any challenges or potential weaknesses we should be aware of? Every business has them, right?
Of course. One challenge is the increasing competition in the analytics space. There are a lot of companies, some with very deep pockets, vying for a slice of this pie.
So MSCI can't afford to rest on its laurels. They have to keep innovating and delivering value to stay ahead of the curve.
Absolutely. And that means not only developing cutting-edge tools, but also making those tools accessible and user-friendly. Clients don't want to spend hours trying to decipher complex data outputs. They want clear, actionable insights that can directly inform their investment decisions.
So it's a delicate balance between sophistication and simplicity. The tools need to be powerful enough to handle the complexities of the market, but also intuitive enough for clients to use effectively. Sounds like a tough needle to thread.
It is. And it's a challenge for everyone in the analytics space, not just MSCI.
Okay, so analytics is clearly a key area for them. But let's shift gears and talk about that other big bet. You mentioned private assets. You said they're making some moves there, but how do they plan to gain traction in a market that's traditionally been so opaque and difficult to navigate? It's a bit of a black box, isn't it?
It is, and that's exactly what MSCI is aiming to change. Their key strategy is to bring the same level of data and transparency to private assets that they've brought to public markets. This means developing robust benchmarks, providing granular performance data, and helping investors understand the risks and opportunities specific to different private investments.
So they're trying to shine a light into that black box, making private assets more accessible and understandable for institutional investors who are used to a certain level of transparency in public markets. Ambitious, to say the least.
It is ambitious, but it's not out of character for MSCI. They have a history of bringing transparency and standardization to previously opaque markets. They did it with emerging markets, and now they're setting their sights on private assets.
And their recent acquisition of Burgess, a leader in private capital data and analytics, will certainly help them in this endeavor. That's a significant move.
Absolutely. Burgess brings a wealth of data and expertise to the table, complementing MSCI's existing capabilities and accelerating their push into the space.
It sounds like they're building a powerhouse platform for private asset investing. But are there any potential roadblocks they might encounter along the way?
There are always challenges. One potential obstacle is the reluctance of some private market players to share their data. These markets have traditionally operated on a relationship-based model with information shared selectively, often through personal networks and behind closed doors.
So it's not just a technology problem. There's a cultural shift that needs to happen. Investors need to become more comfortable with data transparency and standardized benchmarks. and some private market players might resist that.
Exactly, and that could take time. But the trend seems to be moving towards greater transparency, especially as more institutional investors allocate capital to private markets. They're accustomed to the data and transparency of public markets and will likely demand the same in private markets.
That makes sense. They won't be satisfied flying blind. They'll want the same level of insight and control over their private investments as they have with their public ones. And that's where MSCI is hoping to come in.
Precisely. They're aiming to be the trusted guide in this evolving landscape.
Okay, so we've talked about the challenges and opportunities facing MSCI. But let's zoom out for a second. Why should the average investor care about what this company is doing? Does any of this actually matter to someone who's not managing a multi-billion-dollar portfolio?
That's a great question, and the answer is yes, it does matter. MSCI's influence extends far beyond institutional investors. Their indexes, for example, are used as benchmarks for countless mutual funds and ETFs, which millions of people invest in through their retirement accounts, brokerage accounts, you name it.
So even if you've never heard of MSCI, their decisions could be impacting your portfolio indirectly.
Exactly. And their focus on areas like ESG and climate could have a significant impact on the types of investments available to you and the returns you can expect to see.
So these trends are trickling down to the retail investor level. It's not just about the big institutions anymore.
Not at all. And that's why it's important to understand what MSCI is doing and how their decisions might affect your own investment strategy, even if you're not directly investing in their products.
Okay, we've covered a lot of ground here. We've talked about MSCI's performance, their challenges, their opportunities, and their growing influence. But there's one more piece of the puzzle I want to examine before we wrap up, their focus on climate risk.
Yes, that's a crucial element of their strategy, and one that could have significant implications for investors of all types, not just the big institutions we've been discussing.
We touched on this earlier when we talked about their climate-related custom indexes, but I'd like to dig a little deeper into how they're actually measuring and assessing climate risk. What are they looking at specifically? What are the key metrics they're using? Because climate risk can feel like a very broad, almost abstract concept.
It can, and that's why MSCI's approach is so interesting. They're taking a multifaceted approach that considers both physical and transition risks related to climate change.
Okay, break that down for me. What's the difference between physical and transition risks?
Physical risks are the direct impacts of climate change. Things like extreme weather events, rising sea levels, disruptions to agriculture. These are all physical risks that can damage assets and disrupt business operations.
So that's the, oh no, my factory just got flooded kind of risk.
Exactly. But then there are transition risks, which are related to the global shift towards a low-carbon economy.
So the world is moving away from fossil fuels, and that shift is going to create winners and losers in the market.
Precisely. And MSCI is trying to assess which companies and industries are best positioned to navigate this transition and which ones are likely to struggle. They're developing models that analyze how different businesses are managing their carbon emissions, investing in renewable energy, adapting their operations to a changing climate, and so on.
So they're essentially trying to identify the climate leaders and the climate laggards. And they're using that information to develop climate-related scores and ratings that investors can use to make more informed decisions. So hypothetically, you could have a portfolio that's not only diversified across different asset classes, but also aligned with your values and beliefs about climate change.
Exactly. And that's becoming increasingly important for many investors, especially younger generations, who are acutely aware of the risks and opportunities associated with climate change. They want their investments to reflect their values.
It's not just about making money anymore. It's about making money in a way that's sustainable and responsible.
Precisely. And that's a trend that I think we'll see continue to gain momentum in the coming years.
Okay, so MSCI is clearly taking climate risks seriously. But how does this translate into actual investment products and services? What are they offering clients who want to incorporate climate considerations into their portfolios?
Well, as we discussed earlier, they're offering custom indexes that allow clients to tilt their portfolios towards companies that are better positioned for the climate transition. But they're also going beyond indexes and providing more granular data and analytics that investors can use to make more informed decisions at a company level.
So it's about giving investors the tools they need to understand the climate-related risks and opportunities associated with different companies and industries, and then make their own choices based on that information.
Exactly. And that information is becoming increasingly valuable as we grapple with the challenges of climate change.
It seems like MSCI is really positioning themselves as a leader in this space. But are investors actually using these climate-related products and services, or is this all just hype and marketing?
It's still early days, but the evidence suggests that investors are increasingly factoring climate risk into their decision-making. We're seeing a growing number of funds and ETFs that incorporate climate considerations into their strategies, and many of those funds are using data and analytics provided by MSCI.
So it's not just talk. There's real action happening in the market.
Absolutely. And that action is being driven by a combination of factors, including investor demand, regulatory pressure from governments around the world, and a growing recognition that climate change poses significant financial risks, not just environmental ones.
So MSCI's riding a wave here. They're not creating the wave, but they're certainly trying to position themselves to surf it successfully.
A good analogy. They're recognizing a major shift in the investment landscape and adapting their offerings to meet the evolving needs of their clients.
Okay, we've covered a lot of ground here. We've talked about MSCI's performance, their challenges, their opportunities, and their leadership in the climate risk space. But I want to end this deep dive by circling back to a point you made earlier. The idea that MSCI's decisions have ripple effects across the entire investment ecosystem.
Yes, that's a crucial point. They're not just a data provider, they're a standard setter. Their indexes, their ratings, their methodologies, they all influence how investors think about risk opportunity and value.
So their decisions have the potential to shape the flow of capital impact market valuations and ultimately influence how companies behave.
Precisely. And that's why it's so important to understand what MSCI is doing and how their decisions might impact the future of finance, not just for big institutions, but for everyday investors like you and me.
It really underscores how interconnected everything is these days. What might seem like a niche area of finance can actually have far-reaching implications for the markets as a whole, and even individual investors like you listening in.
It's all part of a bigger picture. And speaking of the bigger picture, before we wrap up, I'd like to circle back to something we discussed earlier, MSCI's bets on climate risk and private assets. These are areas that could become even more critical as investors grapple with a rapidly changing world. What might this mean for the future of investing? What opportunities might it present?
It's almost like they're looking beyond the current horizon, trying to anticipate what the investment landscape will look like 5, 10, even 20 years from now.
Exactly. And if they're right and these trends continue to gain momentum, it could fundamentally reshape how we think about investing. Imagine a world where climate risk is priced into every asset, where private markets are as transparent and accessible as public markets. A world where investors have a much wider range of options for aligning their portfolios with their values.
It's a very different world from the one we're in now. Not just about chasing returns, but about impact. About making investment decisions that are not only financially sound, but also contribute to a more sustainable and equitable future.
Exactly. And that's a future that I think many investors, particularly younger generations, are excited to be a part of. They're demanding more from their investments, both in terms of returns and in terms of impact.
Well, on that note, I think it's time to wrap up this deep dive into MSCI.
Indeed. It's been a fascinating exploration of a company that is both reflecting and shaping the evolution of the investment world.
We've covered a lot of ground, from their strong performance in certain areas to the headwinds they're facing in others, their strategic moves into new markets, and their bold vision for a more sustainable and transparent financial future. What are your key takeaways from all of this? What surprised you? And most importantly, how do you think this all plays into the broader economic picture? We'd love to hear your thoughts.
As always, we encourage you to do your own research and stay informed about these evolving dynamics. The future of finance is being written right now, and it's up to all of us to understand the forces shaping it.
Thanks for joining us on the deep dive. Until next time, keep exploring, keep questioning, and keep learning.